The world's largest silver pricing exchange is facing a problem no one wants to admit. The vaults that are supposed to back global silver contracts are shrinking fast, and the numbers suggest something dramatic could happen within weeks. This isn't speculation or hype. This is straight from warehouse reports, open interest data, and audited earnings filings. Inventory that once seemed untouchable is falling month after month. Contracts aren't rolling the way they normally do, and two mining companies just revealed something that changes everything. The silver price you see on your screen may not be the real price at all. 5 months ago, the exchange warehouses held roughly 200 million ounces of deliverable silver. Today, that figure sits under 90 million. More than 110 million ounces have disappeared from registered inventory in less than half a year. That equals a drain of roughly 20 million ounces per month. And the decline isn't slowing down, it's accelerating. To understand why that matters, you have to understand how this market works. The exchange trades futures contracts. Most traders never want physical silver. They trade paper contracts and roll them into future months before expiration. Only a small percentage typically stand for delivery and request actual metal from the vaults. But recently, that pattern changed. Instead of rolling forward, a much larger share of contract holders are demanding delivery. In what is normally a quiet delivery month, physical withdrawals surged dramatically. February saw an unusually high percentage of contracts standing for metal. January delivered volumes several times larger than historical norms for that month. That creates pressure. Because while contracts represent hundreds of millions of ounces, the vault only contains a fraction of that amount in registered, deliverable form. And the current contract rollover from March into May is happening at a slower pace than required. If contracts don't move forward quickly enough, many could remain open into the delivery window, meaning they may request real silver. At the same time, international price differences have created another drain. When silver trades higher overseas than it does on the US exchange, physical metal moves toward the premium. That arbitrage pulls inventory away from domestic vaults and into foreign markets. So the problem has three layers: inventory falling rapidly, delivery demand rising sharply, contract rollover moving too slowly. Individually, each would raise concern. Together, they create a mathematical tension inside the system. Because contracts can be created digitally, silver cannot. And if too many holders request delivery at once, the exchange has only two options: deliver metal or change the rules. Now here's where it gets even more interesting. While inventory drains and delivery pressure builds, two major silver producers quietly released earnings reports. What they disclosed wasn't dramatic on the surface: production numbers, revenue growth, cash balances. But hidden inside those filings was one figure that may be more important than any vault chart: their realized selling price. During the same quarter when the exchange benchmark suggested silver averaged in the mid-$50 range, both companies reported that they actually sold their silver for nearly $70 per ounce. Not one company, two from different regions, with audited financial statements filed with regulators. That means real buyers paid roughly 25-30% more than the widely quoted futures price. Why would industrial buyers voluntarily pay such a premium? If the exchange price were truly reliable, companies needing silver could simply buy futures contracts and stand for delivery at the lower benchmark price. That's how an efficient market is supposed to function. But they aren't doing that. Instead, manufacturers appear to be negotiating directly with mining companies and securing physical supply outside the exchange system. That suggests a growing preference for guaranteed delivery over theoretical pricing. In other words, the market price on screens may reflect paper liquidity, while the physical market operates on different terms entirely. Add to that a government announcement signaling support for higher critical mineral prices, including silver. Officials have openly discussed price stabilization frameworks designed to encourage domestic production. Think about that dynamic. On one side, financial institutions attempt to manage volatility. On the other, policymakers express support for stronger pricing to incentivize mining investment. Meanwhile, physical buyers quietly bypass exchanges and lock in supply at premiums. Inventory shrinks, delivery demand climbs, direct deals expand. If this pattern continues, something has to adjust. Either the vault levels, the contract structure, or the price itself. To really understand what is unfolding, you have to step back and see how the silver market was designed to function in the first place. The futures exchange was never meant to move massive quantities of physical metal every single month. It was designed to provide price discovery and liquidity. Mining companies hedge future production. Industrial users hedge future demand. Speculators provide volume. Most contracts are simply financial instruments, opened, traded, and closed without anyone ever touching a single ounce of silver. That system works beautifully, as long as confidence remains intact. Confidence that contracts will roll forward smoothly. Confidence that physical delivery is available if requested. Confidence that the quoted price truly reflects supply and demand. But confidence is fragile. Over the past several months, something subtle shifted beneath the surface. It didn't begin with panic. It began with quiet withdrawals. Inventory in the registered category, the silver officially available for delivery, started trending lower. At first, the decline looked manageable, a few million ounces here and there, normal fluctuations, nothing alarming. Then the slope changed, the pace of decline accelerated. Instead of small reductions, tens of millions of ounces left the registered category over a short period. That matters because registered inventory is the exchange's last line of defense. It is the pool of metal that stands behind every delivery request. When that pool shrinks rapidly, psychology changes. At the same time inventory was falling, delivery behavior was shifting. In a typical month, only a modest percentage of contract holders actually stand for delivery. Most roll their positions into the next active month. That's how leverage and liquidity remain high without stressing physical supply. But recently, a far larger percentage chose to take delivery. That behavior sends a message. We don't just want price exposure, we want metal. When delivery participation spikes, it introduces friction into a system built primarily for paper rotation. Each delivery removes silver from registered inventory. And if that inventory isn't replenished at the same rate, the balance tightens. Layer onto that the global dimension. Silver does not trade in isolation. It flows where it is valued most. When physical silver commands a higher price in one region compared to another, arbitrage naturally occurs. Traders move metal toward the higher bid. Over time, that movement drains supply from lower-priced exchanges. So if overseas markets pay a premium for immediate physical silver, inventory begins to migrate. It leaves domestic vaults and travels toward the stronger bid. This is not abnormal behavior. It is how commodities respond to price signals. But in a system already experiencing rising delivery demand, those additional outflows compound the stress. Now consider the contract structure. As expiration approaches, near-month contracts typically decline in open interest because traders roll into later months. That rollover must occur at a steady pace. If too many contracts remain open too close to first notice day, the probability of delivery requests increases significantly. Recently, the rollover pace slowed relative to historical norms. That slowdown might be temporary, it might resolve naturally, but combined with shrinking inventory and elevated delivery participation, it creates a narrowing margin for error. Markets operate on margins. There is always more paper silver traded than physical silver sitting in vaults. That is not fraud, it is leverage. It works because not everyone demands metal at once. But when behavior changes, even slightly, leverage becomes more visible. Another important development is price structure. In a well-supplied commodity market, future delivery months typically trade at a premium to the near month. This is called contango. It reflects storage costs, insurance, and financing. When the opposite occurs, when near-month prices trade equal to or above future months, the market enters backwardation. Backwardation suggests immediate demand exceeds readily available supply. Silver recently flirted with that structure. Backwardation is not inherently catastrophic, but it is a signal. It tells you that the market values present delivery more than future promises. That shift in preference aligns with increased delivery participation and direct physical buying. And that leads to perhaps the most revealing piece of the puzzle, the miners. Two major silver producers reported earnings showing they realized prices significantly above the widely quoted exchange benchmark. These were not speculative blog posts. These were audited financial statements. When producers consistently sell at premiums above the benchmark, it implies that real buyers, manufacturers, refiners, industrial users, are willing to pay more for guaranteed supply. Why would they do that? Because certainty has value. A factory that depends on silver for electronics or solar production cannot afford disruption. If there is even a small risk that exchange delivery could be delayed, negotiated contracts with producers become more attractive, even at higher prices. Every direct contract signed outside the exchange reduces the volume of metal that might otherwise replenish exchange inventories. So the system now faces pressure from both ends. Deliveries pulling metal out, direct industrial agreements keeping metal from flowing back in. Meanwhile, governments have begun signaling support for stronger pricing in critical minerals. Policymakers argue that sustained higher prices are necessary to incentivize new mine development, processing facilities, and domestic supply chains. That adds a strategic layer. Mining is capital intensive and slow. New projects often require 7 to 10 years from discovery to production. Even if prices rise tomorrow, new supply cannot appear overnight. Recycling helps, but it cannot instantly offset large structural demand shifts. So supply is relatively inelastic in the short term. Demand, however, is persistent. Silver's role in renewable energy, electronics, defense systems, and advanced manufacturing continues to expand. Even small percentage increases in industrial demand can meaningfully impact available inventory when stocks are already trending lower. None of this guarantees a crisis, but it does describe a tightening system. When inventory declines, delivery rises, rollover slows, backwardation appears, producers receive premiums, and policymakers endorse higher pricing. Those are not isolated data points. They are reinforcing signals. Markets adjust when signals align. Sometimes the adjustment is gradual. Prices climb steadily until supply and demand rebalance. Sometimes the adjustment is abrupt, triggered by a catalyst, a rule change, a margin increase, or a sudden spike in delivery requests. What matters most is not whether silver runs out. It is whether the balance between paper leverage and physical availability remains comfortable. Right now, that comfort appears thinner than it has been in years. And when comfort thins, volatility tends to follow. The coming weeks will reveal whether rollover accelerates, inventory stabilizes, and premiums narrow, or whether the divergence between paper price and physical demand continues widening. Because in commodity markets, when physical reality begins to challenge financial structure, price discovery eventually shifts. The only question is how, and how fast. Now here's the part most people miss. The silver market is not collapsing. It is not running out tomorrow. There is no dramatic vault door swinging open to reveal emptiness. What is happening is far more important and far more powerful. The structure is tightening. For decades, the silver market operated on a simple understanding. Paper contracts would trade in massive volume, while only a small fraction would ever require physical delivery. The system relied on predictability. As long as most participants treated contracts as financial tools rather than claims on metal, the balance held. But the balance depends entirely on behavior. When more participants begin asking for delivery instead of rolling contracts forward, the leverage embedded in the system becomes visible. Not broken, visible. The ratio between paper claims and physical supply only matters when confidence shifts from price exposure to possession. And that shift, even if gradual, changes everything. Registered inventories declining month after month are not a headline crisis. They are a pressure gauge. Elevated delivery participation is not a failure. It is a signal. Producers reporting realized prices above benchmark exchange quotes is not manipulation. It is evidence of tightness in the physical channel. Individually, these are data points. Together, they form a pattern. Here is what that pattern suggests. The paper price is no longer the only price that matters. Industrial users appear willing to secure supply directly from miners at negotiated premiums. That tells you certainty is gaining value. Manufacturers cannot risk production delays in sectors like electronics, solar, or advanced defense systems. If paying above benchmark ensures uninterrupted flow, the premium becomes insurance. At the same time, exchange inventories are not being replenished fast enough to offset delivery withdrawals. Mining supply cannot respond quickly. New projects require years of development, regulatory approval, and capital investment. Recycling helps, but it cannot instantly bridge structural demand growth. This is what tightening looks like before it becomes obvious. Markets rarely break overnight. They compress first, spreads narrow, backwardation flickers, premiums widen quietly, delivery percentages creep higher. None of it looks dramatic in isolation, but compression builds tension, and tension resolves. The resolution does not require vaults to be empty. It does not require conspiracy. It requires only one condition: sustained preference for physical over paper. If that preference continues, one of two adjustments must occur. Either more metal flows into exchange inventories, meaning higher prices, incentivize sellers to part with physical supply, or the price structure shifts upward to rebalance demand. In commodity markets, price is the release valve. Higher prices are not a malfunction. They are the mechanism that attracts supply and discourages excess demand. Policymakers discussing stronger pricing for critical minerals reinforce this idea. If governments want domestic mining expansion, higher sustained prices are necessary. So the reveal is not that the silver market is about to fail. The reveal is that the market may be transitioning from an era dominated by financial rotation and abundant leverage to one increasingly influenced by strategic demand and physical prioritization. That transition does not happen in headlines. It happens in data trends. If rollover activity accelerates and inventories stabilize, pressure eases, the system continues functioning as it has for decades. But if deliveries remain elevated, if premiums persist, if industrial buyers keep bypassing the exchange, then the paper price must eventually reconcile with physical reality, not through drama, through repricing. And repricing, when it comes, often surprises those who assumed the old balance would hold forever. The silver market is not screaming, it is tightening, and tightening systems do not stay neutral indefinitely. Now I want your perspective. Do you believe the futures exchange can navigate this tightening cycle without major rule changes? Or do you think intervention is inevitable if delivery pressure continues? Look at the signals. Inventory trends, rollover pace, premiums reported by miners, price structure between months, policy statements supporting stronger mineral pricing. Individually, each can be explained. Together, they form a pattern. If you hold physical silver, how do you interpret these developments? Do you see them as confirmation of long-term value? Or do you believe the exchange system will normalize and premiums will disappear? Drop your view in the comments, yes or no on intervention, and explain your reasoning. I'm interested in both sides of the argument. If this breakdown helped clarify the moving pieces behind silver pricing, share it with someone who follows metals but hasn't connected the inventory data with miner earnings yet. The more perspectives we examine, the clearer the picture becomes. Over the next few trading sessions, several signals will reveal which direction this story moves. Watch the daily change in open interest. If contracts exit the near month quickly, pressure eases. If they linger, delivery probability rises. Monitor registered inventory levels. Stabilization would calm fears. Continued decline would intensify scrutiny. Observe the spread between near and far months. A widening premium for immediate delivery would indicate urgency remains. Listen for exchange announcements. Margin hikes or rule adjustments often precede volatility. And pay attention to future earnings reports from producers. If realized prices continue exceeding benchmarks, that divergence becomes harder to ignore. Markets rarely shift overnight, but they do evolve when incentives change. Right now, incentives appear to favor physical control over paper exposure. Whether that leads to gradual repricing or sudden adjustment remains uncertain. But one thing is clear. The relationship between vault inventory, futures pricing, and direct physical premiums is tighter than it has been in years. Stay informed, stay analytical, and watch the data, because the next chapter in silver pricing may already be unfolding.